Here's chapter 6 on inventory. Before we start with costing on inventory, we need to understand sales, cost of goods sold, gross profit, and ending inventory. How do all these four key terms work with each other? They're all related to each other. Let us say I go and purchase 100 cookies from the store, each at 60 cents. So $0.60. Okay. So I purchase 100 cookies and I'm going to try and sell these 100 cookies at $1 each. So my sale price per unit is going to be $1 each. Now, when I try to sell the cookies, I obviously want all the 100 to be sold as quickly as possible. However, let us say I end up selling only 90 cookies. So 90 cookies are sold. Now let us calculate the sales in dollar terms. So the sales equals 90 cookies times $1 each. Remember, I have priced it at $1. So sales is $90 and the cost of goods sold for these 90 cookies is 90 times 0.60, which is $54. So what is the meaning of cost of goods sold? This means what is the cost? How much did it cost for me to procure those 90 cookies? Those 90 cookies were procured at 60 cents each. So 90 times 0.60 is $54. So the cost of goods sold means exactly that. What is the cost on these sales? Okay, so the sales includes the markup of the seller. So I have purchased at 60 cents and I have marked it up by 40 cents and therefore I'm selling it at $1 each. So now the gross profit on my sales of 90 cookies is $36. That's my gross profit. Now the last part of it is what is my ending inventory? My ending inventory is the goods not yet sold and I have not yet sold 10 cookies. And this ending inventory, this is the most important part here, this ending inventory has to be valued at cost, which is 60 cents. So therefore, this 0.60, so these 10 cookies which is in the ending inventory is now valued at $6. So if you were to make a balance sheet to show the value of the ending inventory, you have to value the ending inventory at cost, and therefore 10 cookies at cost is $6 and the gross profit is $36 from the sales of 90 cookies. Now, if we were to translate this into an equation, the company started with beginning inventory of 0, purchased 100 cookies, This is the purchases. This is the beginning inventory. And this beginning inventory plus purchases equals the goods available for sale. So continuing with the equation, beginning inventory plus net purchases equals the cost of goods available for sale. Now we are going to denote all this in dollar terms. Now from the cost of goods available for sale, if we subtract out the ending inventory, we get the cost of goods sold. I'm going to illustrate this with the same example. Now in that same example last time, in the last slide, let us say the company had started with 10 cookies purchased at that same 60 cents. So they had left over from the last accounting year 10 cookies at 60 cents. So they had $6 worth of beginning inventory, and to that the company added 100 cookies at 6 cents. We'll keep it 60 cents. We'll keep it all simple here. So at 60 cents they purchased 100 cookies, and this led to another $60 here. So the total is 6 plus 60, which is 66, and this 66 equals the cost of goods available for sale. Now intuitively what this means is that the cookie store has now got $66 worth of available cookies for customers to come and purchase. Now, if we were told that the ending inventory in this store equals $6. Suppose we are told that ending inventory is $6. The value of ending inventory is $6. Then we know that if we subtract the $6, if we subtract the $6 of ending inventory from the cost of goods available for sale, what we get is $60, and that represents the cost of goods sold. So in other words, if we know that there was $66 worth of goods in the store, and all we are left with at the end of the year is $6 worth of ending inventory, then we can infer that 66 minus 6, $60 of cookies got sold during the year. So this is the equation that's important. Beginning inventory plus net purchases equals cost of goods available for sale, and cost of goods available for sale minus ending inventory equals cost of goods sold. So here's inventory costing. Let us start with specific identification method. Here's an example of a company that will use the specific identification method. They are selling high-end necklaces and high-end jewelry, very ornate, and each one is custom made. The keyword is custom. So in their store, they have several pieces of jewelry and the costing on four of them are shown here as an example. Now the first one costs $1,000, the second one costs $2,000, the third one costs $500, the fourth one costs $600. This is the cost to the company. And the company also has a sale price on each of them. These are the costs. And then there is also a sale price that the company has on each one of them. For example, this $1,000 one could be having a markup of $500 and the sale price could be $1,500. Now let us try and see how the specific identification method works. Now, if a customer comes into the store, looks at all these four items that are there for sale, and she likes the one here which costed the company $1,000. So she liked item 1 and the company is going to quote $1,500 as the sale price. So now the specific identification method accounting requires that the sale price be shown at 1,500, the cost of goods sold be shown at $1,000, which is the specific cost of this item that was picked up, and the gross profit is 500. In other words, we do not average the price across the cost across these four necklaces. We specifically identify which necklace was sold and we take the cost of that necklace and we subtract that from the sale price. This is the specific identification method used for high-end custom goods typically. Now let us look at the weighted average cost method of valuing inventory. So it's called the weighted average cost. So here the best way to do it is to look at an illustration. 3 dates, the company starts with beginning inventory of 100 units and then purchases of 300 units on April 25th and another purchase on October 19th of 600 units. Now the unit cost on each of them, this was purchased at $7, this is at 9 and this is at 11. Now the key thing to remember here is that these are all identical units. There is no difference. However, they have been procured at different points in time. They are looking very similar. They are not exactly the same, but they're all together. So imagine when you walk into Walmart and you're looking at bananas there, and those bananas that are in the store under the green grocery section, they are perhaps procured at different points in time, and because they are procured at different points in time, they are having different unit costs. Okay, so should the store find out every time we purchase something what is the cost of that particular banana depending on where it was sourced from? It should not do that, or it need not do that, because it is not worth looking at the costing on each banana and identifying that and then matching the cost to whatever we have picked up at the sale point. In order to be more efficient with inventory costing, for identical goods, stores will go ahead and use a technique such as weighted average cost or first in first out or last in first out. These are based on inventory costing assumptions. These methods are costing assumptions, and right now I'm going to illustrate the weighted average cost method. So here you have the units and the unit cost, and the total cost of goods available for sale is $700, $2,700 and $6,600. So the total goods available for sale is 1,000 units and the cost is $10,000. Now assume that 800 units were sold. It doesn't matter which of these 800 units. The customer could have picked some from here, some from here, some from here. It doesn't matter. What we are going to do is we're going to learn how to find the weighted average cost of these 1,000 units. The formula for weighted average cost per unit equals goods available for sale divided by number of units available for sale. So in this case, it is $10,000, which is the cost of, this is the cost of goods available for sale. Cost of goods available for sale divided by number of units available for sale. So $10,000 divided by 1,000 units. So the average cost, the weighted average cost equals $10 per unit. So therefore, the 800 units of sold goods should be costed at $10 per unit. So the cost of goods sold on the 800 units is $8,000. Now there are 200 units in ending inventory. So ending inventory is 200 units. Cost of goods sold is 8,000. So the 200 units should also be costed at $10, and this is $2,000. Now the important thing to note here, the most tricky thing about weighted average cost is the average should not be done across 7, 9 and 11. We should not take 7, 9, 11 and just do 7 plus 9 plus 11 by 3. That is wrong. We should multiply times the number of units. That's why it is called the weighted average cost. So 100 times 7 plus 300 times 9 plus 600 times 11 gives a total of 10,000, and then we divide by 1,000, which is the number of units. So then we get the weighted average cost per unit. Let us illustrate the inventory costing assumption first in first out, FIFO for short, with an example. The beginning inventory in a store is 100 units. Costing on this is $10 per unit. And then the company purchased 200 units at $20 per unit. Now these are homogeneous products, which means that they are not different in any features or quality. The only difference is the cost of the products and the date on which it was purchased. This is the beginning inventory on January 1st, and let's say this was August 30th. Now the company sells 150 units. And now, how do we find out the cost of goods sold on this 150 units? Should we take these 150 units from August 30th or from January 1st? Now, if we make a sum from January 1st and some from August 30th, so the costing will be different if we looked at August 30th inventory, and it will be different if we looked at the combination of January 1st and August 30th. In other words, if we costed this 150 units at $20 per unit from the August 30th batch, the cost of goods sold is going to be different and the gross profit is going to be different. If we took that 100 units of beginning inventory and then 50 units from the August 30th and added those up and came up with the cost of goods sold, the gross profit is going to be different. So that is why a consistent inventory costing assumption is important. And now we're going to see how the first in first out works. The first in first out is a top-down approach where you start with this, what is first there in the inventory. So 100 units was there first, and that gets out first of the door. So 100 units, that was the oldest, gets out of the door first at $10. And remember, this is a costing assumption. Okay, this is not the actual goods that may have gone out. We do not know that, but we are just using this method of costing. And then we take 50 units here, and together we have 1000 plus another 1000, which is $2,000. Now, why did we take 50 units only from August 30th? Because the total sale was for 150. We already have in the beginning inventory 100 units. So how much should we take from the next set such that the total is going to be 150? We need 50 from 200 to make this total equal to 150. So 100 from the beginning inventory plus how much makes the total 150. So we take 50 from the August 30th. So this is your cost of goods sold. Now the question may also give you some information on sale price, and the sale price might be, for example, $30 per unit, in which case 150 units were sold at $4,500, and then the cost of goods sold is $2,000, and the difference is the gross profit, which is $2,500. Now, the question might ask you to do three types of calculations in this entire unit. Cost of goods sold, which is this, or ending inventory calculation, or the gross profit, which I showed in the previous step. The only thing we need to still cover is the ending inventory costing. So 150 units have been sold, which means there is yet another 150 units in the ending inventory. And this 150 units is remaining from the August 30th purchases, and therefore it has to be costed at $20. And so you have the value of ending inventory to be $3,000, the cost of goods sold to be $2,000, and the gross profit to be $2,500. The next method is last in, first out, which is the flip of the first in, first out method. Beginning inventory 100 units, purchases 200 units, sales 150 units. Costing, beginning inventory at $10 per unit, purchases at $20 per unit. The next purchase is on August 30th. Same numbers as last time. Now let's try to find out the cost of goods sold for these 150 units. When we use the last in, first out costing assumption, it's a bottom-up approach. So we first take the 200 units and from there take out 150 units times $20. So the costing assumption is last in, first out. The August 30th purchase was last in, so that goes out first. So 150 times 20, cost of goods sold equals 3,000. Now the sales was at $30 per unit, so this is 4,500. Now sales minus cost of goods sold is the gross profit, which equals 1,500. And the ending inventory is 50 units from this lot is remaining because 150 went here. So 50 at $20 plus 100 at $10. So we have 1,000 plus 1,000, which is $2,000, the value of ending inventory. When costs are rising, FIFO will show a lower cost of goods sold. It will capture lower costs in the cost of goods sold, and therefore it will have a higher net income, all else equal. When costs are rising, LIFO will be more conservative because the higher cost of goods sold, last in, first out. So if this is the timeline here, the cost of goods sold will capture the last in prices which are higher. So this will be LIFO, cost of goods sold will be conservative, leading to lower net income, all else equal. Finally, we look at the lower of cost or market value. The textbook in this case uses the term net realizable value in page 288, but what they mean is the market price. Now, under conservative reporting, the inventory, the ending inventory is reported at lower of cost or market value. The textbook uses the term net realizable value to refer to market value. So what this says is if the cost of the ending inventory is lower than the market value, report the ending inventory at cost. However, if the market value becomes lower, use the lower market value to report the ending inventory. So all we are doing in this principle is to use the lower of the cost or the market value always to report the ending inventory, and this is an evidence of conservatism in accounting. We are not using the higher number, but we are using the lower number. And finally, there are some ratios that one has to remember for this chapter, and they are inventory turnover ratio, average days in inventory, and gross profit ratio. They are in the textbook, and these are also part of the coverage in chapter 6.